You didn't negotiate your loan interest rate. It was decided without you, in a room you'll never see, by people who don't know your name. And it happened before your loan officer even smiled. That sounds dramatic, but it's also true. Right now, as you watch this, trillions of dollars are being quietly offered, rejected, and repriced in a daily ritual that decides how expensive your future will be. Not just your mortgage, not just your car loan, everything tied to borrowing money. This matters more today than it did a few years ago. Rates move faster now. Debts are larger. Margins are thinner. A small shift can mean the difference between manageable and impossible. So let's talk about the silent auction that sets your interest rate. Not with jargon, not with charts, with a story. Imagine the government needs money, not because it's broke today, but because that's how modern systems run. Roads, salaries, old debts. So it issues IOUs, bonds. Here's the key part. It doesn't pick the interest rate. It asks the market. Banks, funds, institutions, massive players with spreadsheets and patience. They all submit bids. Quietly. No shouting, no drama. Just numbers. I'll lend if you pay me this much. No, I need more. Fine, but only if inflation stays calm. The government accepts the best offers. That average becomes the new baseline. That's the auction. And it sets the tone for everything else. Because once the safest borrower on earth agrees to pay a certain rate, everyone else has to pay more. You included. Now here's where it gets uncomfortable. Banks don't price your loan based on you. Not really. They price it based on what they could earn elsewhere. If a bank can lend to the government at 5% with almost zero risk, why would it lend to you at 4%? It wouldn't. So your rate becomes the government rate, plus a little extra for risk, plus a little extra for profit, plus a little extra because they can. That's the math no one puts in the brochure. This auction happens constantly. Different timelines, different maturities, short-term, long-term. And markets react instantly. A rumor of inflation, a hint of political chaos, one unexpected speech, rates jump, and suddenly millions of people refinance plans die overnight. Here's the irony. When central banks raise rates, they're not directly raising your loan cost. They're nudging this auction, whispering to it, making safer options more attractive so money flows away from risk. The headlines say control. The reality is persuasion. And sometimes the market ignores them. That's the part people don't like to talk about, because it means no one is fully in charge. There's another quiet detail. Most banks don't keep your loan for 30 years. They sell it, bundle it, pass it on, which means your interest rate also reflects how attractive your debt will look to strangers later. You're not just borrowing money, you're becoming a product. Hype tells you rates are about policy, or presidents, or announcements. Reality is colder. Rates are about competition between giant pools of money deciding where to hide next, and you're downstream from that decision. Zoom out for a moment. This auction decides how fast economies grow, how easily businesses survive bad years, how painful recessions become, when debt breaks things instead of fueling them. When rates rise too fast, even healthy systems crack, not because people were reckless, but because the cost of time itself suddenly changed. That's what interest really is, the price of time. And right now, time is expensive. So the next time someone tells you to shop around for a better rate, remember this. You're not shopping in a market. You're reacting to an auction you were never invited to. The real question isn't whether rates will go up or down, it's who this auction is trying to protect next, and who it's quietly willing to sacrifice.